So we are doing inventory valuation. Can you tell me what is inventory? Can you tell me what is
Inventory is basically the stock that businesses buy to sell.
Okay, that is purchases. What you're buying to sell is called purchases. Now I am talking about inventory. What is it?
Stock of goods
It is a stock of goods. Which goods?
which you will sell.
That is purchases.
Okay, which are used to make a product or something.
So this is the stock of goods that is unsold. Okay, this is a stock of goods that is unsold, and you can have unsold stock of goods at the beginning of the year, and you can have unsold stock of goods at the end of the year. Are you with me? Are you with me?
Yeah.
So when you have unsold stock of goods at the end of the year, this is something that is referred to as the closing inventory. The inventory that is lying in your godown, unsold, which will be sold next year. Are you with me?
Yeah.
Now, there is a purpose of doing this. We need to value our inventory on the last date, and we have to remove this inventory from the cost of sales. See, what I buy now, I sell now, I immediately know the profit of those goods, right? If I buy 10 units, I sell 10 units, I will make profit for 10 units, and I will know the base is the same. But if I buy 10 units, I sell 2 units, can I get the profit? If I compare the cost of 10 units with the selling price of 2 units, am I being able to get the correct profit?
No, miss.
No. So you have to remove the cost of 8 units from your purchases. That is called the closing inventory. So you will remove the cost of 2 units from your purchases so that you arrive at proper profit. That is the reason you deduct closing inventory from your cost of sales. Are you with me?
Yes.
Now, our main purpose why we are doing this chapter is to find out the valuation of inventory that has to be deducted from your cost of sales. So, closing inventory. There is a principle to value closing inventory, and this principle is in accordance with IAS 2. IAS 2, International Accounting Standard 2, gives us the principle to value inventory, and it tells us that whenever you are valuing your inventory, I'm repeating it again, it tells us that whenever you are valuing your inventory, it should be valued at cost or NRV. When I talk about NRV, it is nothing but the net realizable value. The value that you will realize, you will get it in the market. So your inventory should be valued at cost or NRV, whichever is lower. This is the principle in accordance with IAS 2. IAS 2 is particularly for valuation of inventory. Can you tell me what does this IAS tell us inventory should be valued at?
At cost or net realizable value, whichever one is lower.
Whichever one is lower. But when I'm arriving at cost, there is something that I need to add. When I'm arriving at NRV, there is something that I need to do. So when I talk about the cost, it will always be the purchase price plus the carriage inwards. Are you with me?
Yes, miss.
So when I talk about cost, it will always be what? Purchase price plus carriage inwards. What is carriage inwards?
Is the cost for bringing goods to that certain place where you store it.
Yes, perfect. When I talk about NRV, what is it? Net realizable value. That means it is the selling expense minus all cost that is needed to bring the goods in the sellable condition. That means it is the selling price minus the estimated selling expenses. What did I say? Selling price minus
Minus the estimated selling expenses.
expenses. Why does the NRV come into picture? Sometimes what happens is when you're putting your goods in the go down, your goods, your inventory can get damaged. When this thing gets damaged at that point or at that position, you are unable to sell it at the normal price. It is possible that you will not even recover your cost. So at that time, it is not okay to value your inventory at cost. You have to value it at a price at which you can sell. So when I say you have to value it at a price at which you can sell, that is called the net realizable value. But there could be a condition that even when you want to sell it, you have to do some repairing expenses. So the estimated selling expenses has to be minus to come at NRV. Are you with me?
Yes, miss.
Okay. So inventory is valued at,
At cost or NRV, whichever one
whichever.
is low.
When I'm finding the cost, what should be added?
The purchase price plus the carriage in.
When I'm doing the NRV, what should be taken into consideration?
Selling price minus the estimated selling expense.
Very good. Now this is your computer. This is the cost, this is NRV, and this is the valuation. Remember at what price you value, that is the price that will be shown in your current asset. Okay? Come on, computer one. This is cost, this is NRV. What will you value it at?
We have the cost and the NRV, so we'll put it at NRV value.
So you have to say this again and again. Cost or NRV, whichever is lower.
Lower.
Okay? Because we don't have time now. You have to finish this topic now with me. Come on, computer 2.
NRV.
Cost or NRV, whichever is
Yeah.
lower. So 1100. Computer 3.
So NRV again.
Cost is 2500. NRV 2400, whichever is lower. Computer 4.
We'll take the cost
Cost,
because cost is
whichever
lower.
is lower. And the closing stock will be addition of all these items. Are you with me?
Yes, miss.
Come on. Read this MCQ. Please read it, Haris.
Which item is not included as a part of net realizable value? A part of the calculation of net realizable value when valuing so carriage inwards
Carriage inward is a part of what?
is a part of cost when we calculate the cost.
It is the part of the cost. So what is a part of cost cannot be a part of the NRV. Now you have this sum over here and you have to value the closing inventory. I'm giving you like 3-4 minutes of time. You can do this sum yourself and give me the valuation of the closing inventory. Okay, I'll pause the video. Understand, this is a sum of May, June 2022, paper 22. Are you with me? Hello.
Yes,
How?
miss.
This is a sum of May, June 2022.